All right. Well, I'd like to say thanks for having me here today. Appreciate it. Got a good group here. So let us get started. Let me know if you can't see my screen or hear me okay. And that being said, let's get going. So what I'm going to talk about here today is one of my favorite trading strategies. It's the high reward, low risk option trading strategy that involves the option butterfly spread. So trading for yourself can be one of the most rewarding jobs out there, but you really need to stay educated about what you're trading and stay really focused about managing your risk. So, we get into periods of volatile times like we're in now. It really pays to have some good risk management and know what you're doing as far as trying to manage your positions. But, it can also be very stressful at times, which I'm sure everybody here can attest to. So what I want to show you here today is a strategy that I like to use that, it's my favorite kind of go-to strategy. That's a very high reward, low risk, low stress option strategy that involves using the butterfly spread. So, I've been actively trading for over 30 years and was prior to that, my first start in the business was back in the 80s trading cargoes of crude oil, and went on to be executive vice president for one of the largest oil trading companies in the world, Trans World Oil, and managed their international trading desk for over 10 years. And we were one of the first groups to start trading over-the-counter options, and so got my start back in the mid-80s on options and have been passionate about options ever since. Went on to launch the institutional over-the-counter options crude oil brokerage desk for a company called PVM Oil London, and they're the largest privately owned oil brokerage company. So another really great learning experience just based on, options. So, I'm glad everybody's here today because, we're all here looking to learn, and I learn something each and every day. So hopefully you'll learn something about this strategy today, the butterfly spread. So the following webinar is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. Now, this is one of the best ways to profit from options, and it's the butterfly spread. And I've learned and taught a lot of different trading strategies over the years, but when I thought about the most valuable go-to trading strategy that could literally help every single trader out there more than anything else, I knew it was going to be the butterfly spread. Now, the huge advantage to the butterfly strategy is its unique framework that allows for more consistent and greater returns due to its simple but dynamic structure. And it's also because it requires only a small amount of your hard-earned capital. So your trading stress is, really reduced because you're not going to have as much capital at risk. One second. Now, unlike other option strategies such as an iron condor, credit spread, or debit spread, butterflies are very dynamic and can be traded for a variety of different reasons. So with little different goals in mind. In other words, you can learn how to trade butterflies and you're covered for both the offense and the defense. So your goals and your protection. So that's the great thing about it. You can use it just for hedging. You can use it for, directional, non-directional. It's got so many different varieties of way to incorporate this particular strategy. So it can work no matter what the markets are doing. The markets can be up, they can be down, they can be a sideways. It can provide income from stocks that are going nowhere. It can really help you to eliminate the stress of trying to pick the direction of your stocks or the overall market. It'll really help you to eliminate the time decay expenses that many traders have from decaying long options. And it takes away that unsettling guesswork out of your trading. They can also be structured for very low cost trade setups that offer you very high reward to risk, such as 10 to 1 or higher, which I'll show you as we go forward here. Now, unlike other option strategies such as the iron condor, credit spreads and butterflies are very dynamic. And I went the wrong way. Hold on. So butterflies, here's some additional benefits. They're very flexible, as you're going to see ahead. Now, once you learn to set them up, you can adapt them for both your goals and your market insights. And you can construct the butterflies to be delta neutral, where you have really no market direction, but they can still really pay off well for you. Now, the beauty is that they can also be directional. And, to me, trading really comes down to direction. So it presents one of the best option strategies out there for a bullish or bearish type exposure to the markets when you feel pretty sure or confident this, a stock that you're trading is headed one way or the other. But if you're wrong, the butterfly really helps you to manage your risk and then retain large potential returns. So it's a really win-win situation for the trader. Now, let's be real though, the butterfly spread, it's not going to offer you that unlimited profit potential. They usually cost you a lot less than buying outrights and offer an amazing positive risk reward ratio setup. So this means that the butterflies can significantly increase the probability of your winning trades while also reducing your risk. And that's really what it's all about. Now, here's one of the great things about the butterfly. It can be used to hedge. And when you mess up, we're all going to do at certain times, it's one of the best defensive strategies you're going to see out there. So the directional butterfly, it's a fast way, low cost way to cover your pronto when a position starts to move against you. So by constructing a butterfly around a strike that is under pressure for another core type trade setup, such as if you had a credit spread or debit spread on that's starting to go against you, it becomes a great way to control your risk at the same time lowering your trading stress. So what it does, it helps you to cover the original position by opening a butterfly around it. So many times all you really need is some additional time for that trade to come back into favor. So if probably we've all been here, I'm sure I've been here a number of times, where you have a trade that you set up that looks great going into it, and it starts to move in the right direction, then all of a sudden it stalls out, and starts to kind of correct back on you. So you're still confident that potentially it's going to make it back and go in the same direction, but your option is to stop it out, and a lot of times you'll stop out and then you'll see it move back in that direction of the trade where it was originally set up, and you're kicking yourself. So what I've found is by constructing a butterfly around it, the benefits of the time decay aspect of it can help you buy time until it settles back into its original trade setup or movement, and then you can just take the butterfly off and let the trade or the original trade go back in the same position, ride it for all it's worth. So it's a really great strategy for buying time to defend a trade that's starting to stall out against you. So it's also great for long-term out-of-the-money put butterflies. Can be a much cheaper method of portfolio protection than pure long puts. And it's also what we call low maintenance. You're going to hear butterflies are sometimes referred to as the vacation trade due to their low risk and need for only very infrequent monitoring. And we all need a vacation at times, and summertime is here, so it's one of the great strategies to put on where you don't have to constantly be monitoring the trade each and every day. Now, here's what we're going to go through the construction of the butterfly and show you some of the various strategies. But basically what you see here is it looks like a tent. So the maximum profit will be up here at this kind of the apex top of the tent, and then all inside of the tent is your profit zone. And then you've got your risk is limited to the downside and upsides. So you've got a great profit potential all throughout this profit tent. So we're going to go through some examples here to show you how this works. So let's take a look here. Now, here's an example. Assuming that XYZ is traded at $45, and you're looking for this company to move down, and you've got a price target. You think it's going to move to $43. So, one strategy would be to set up a directional butterfly for a target price of 43. So in this example, you're going to buy, set up the butterfly. Let me get my pen. So in this example, you're going to buy one contract of the July 42 calls, and you pay $2.38. So that's a debit, or $238. And then you're going to sell two of the July 43 calls at $1.67, or $167 per contract. And then you're going to buy one additional July 44 call at $1.06, so $106. So these are your wings of the butterfly, and this is the short strikes, or your body. So that's where it gets its name, the butterfly. So your wings are we're long this butterfly, so you're long the 42, you're long the 43, and you're short the 43. So basically, here's what your cost is. It's just taking your long calls at the 42 strike of 238, and your long call at the 44 at $1.06, less the credit you brought in from selling those 243 calls at $1.67. So your max at risk, or at exposure, capital at risk in this example, is $10. So remember, one option contract is equivalent to 100 shares. So multiply it by 100, and this is your risk for this particular spread. Now your profit is calculated by just taking that middle strike, the 43, minus the lower strike to give you your width of the spread, minus your cost or your debit times 100, and that's going to give you your theoretical profit for this trade. So that'd be 43 minus 42 minus your at risk of 10 cents, which is 90 cents times 100. So your theoretical potential profit's 90. Now that divided by your $10 per spread gives you a 900% return on your capital at risk, or 9-to-1 positive risk ratio. So that's the beauty of this strategy. You can get into these for very low cost, and they're fantastic for upside, high return on your. Okay, so let me get my pen rid of that. So what's the core concept, for the butterfly trade? So let's take a look at that before we move forward. Now, the most important option factor for profit generation using the butterfly strategy really comes down to truly understanding the concept of time, or theta, and pricing, and their effects on the price of the option. So let's review the core concepts here of price and how it's affected by time. Now, when we're looking at options, the most really important option factor really comes down to time value, or the extrinsic value of the option. It's the premium that a rational investor would pay over its current exercise value, the intrinsic value, based on its potential to increase in value before expiring. Now, this probability is always going to be greater than 0. Thus, an option is always going to be worth more than its current exercise value. So the change in this value of the option is based on time decay, and we can measure that using the Greek theta. So that's really the great thing about options. We've got these various measurements that are theoretical, but they do help us to kind of look at the options and see what's happening based on the theoretical composition of using the Greeks. So, theta is one of the Greeks that's going to tell you how much an option price will go down or diminish over time, which is the rate of time decay of a stock's option. And time decay occurs because that extrinsic value, or the time value of an option, goes down as expiration draws near. So you can think of a option kind of like a coupon that you get at a grocery store. You're going to have to use it, redeem it before the expiration date, or else it's no longer valid. So that's the same concept of an option. And we can measure how much that option is going down each and every day by that theta value. Now, option theta values are either going to be positive or they're going to be negative. So all long stock option positions, such as a long call or a long put, will have negative theta values, which indicates that they're going to lose value as expiration draws near. And all short stock options, such as a short put or short call, have positive theta values, which indicate that that position is going to gain value as expiration draws near. So by knowing these and knowing how to incorporate those into our strategies, we can take advantage of this theta and theta decay, and it can really be a very big benefit. And that's one of the main benefits and advantages of the butterfly, is using the theta decay and also implied volatility. And you'll see this in some examples I'll show you in a few minutes. Now, the next thing that you want to do is kind of understand the core concept of price for option. And to value an option, it's basically that time value component times the implied volatility component times the underlying value of what you're trading, the intrinsic, extrinsic value. And once you know these variables, then you're going to be ready to price the option, know what options premium should be, and then also have a better understanding of what option strategy that you should use. So here's a table to kind of illustrate these components and how they work on price to define price. So here's a weekly table for weekly options. Now, most all the big options now will have weekly options, which are a great way to trade. And on Thursday, your first day of a new series of a weekly option, you're going to have 100% time in that option. So you've got your time value, then times the implied volatility, then times the underlying value, the intrinsic, extrinsic value. That gives you your underlying value. We'll keep that constant. That gives you your price of the option. So that's basically the core concept. Time value times implied volatility times the underlying equals your option premium. So you can see here, day one, 100% times time in that option times the implied volatility, I put it 300, times your underlying security value, so I kept that constant, so you can see how time value and implied volatility work on price. That gives you a price here of $300. Now you can see here on a Monday you come back in after a weekend, and you can see now your time value has gone down to 50, been cut in half. And even if you increase the implied volatility in this example to 800, you can see that your premium is still, only to 400, barely went up. Now let's say here you only had your implied volatility of 300. You can see then your value of this option has actually gone down from that first day. It would be $150. So the main takeaway here is to see that time value will go to 0 and implied volatility will go to 0 at expiration. So by knowing these core concepts, you're going to know that if you're buying options, you better be aware of the erosion of value of that option based on time, plus the effect that implied volatility has on it, and also be able to take advantage of these two major components for price. So that's really what really affects the butterfly quite well, is time value and implied volatility. Now, the next thing is, well, how do you choose the best butterfly strategy, for your trading goals? One major goal of every trader, really, in my opinion, should be to select trades that are based on what's going to provide you the most consistent positive returns, and not the biggest returns. So they're also going to, give you. I look for very low capital at risk type trades, very defined risk, and not always the greatest returns. So I'm looking for consistent profits, have that equity curve to be very consistent, rather than have a lot of volatility and a lot of swings. And one of the best ways to achieve this is by being aware of the different option butterfly strategies that are available, understanding how they work, and then selecting the one that is best suited for the market environment you're trading and your specific goals as a trader. Now, here are the different structures. You've got a variety of different butterfly strategies. You've got the long call or put butterfly. You've got a broken wing or put. You've got the broken wing butterfly you use calls or puts for. You've got what I've termed the ninja ratio butterfly, which is a really unique, very fantastic strategy. Directional butterflies, iron butterfly, and then hedging. So it's a lot of different variations of ways that you can use this strategy. So let's take a look and review these trading strategies, and so you'll see, how they perform and some of the advantages that they offer you. So here's a directional butterfly spread trade setup that was on Alibaba, and most of my trading, is pretty much comes down to direction, but then I look for the direction, and then I look to apply certain option strategies. So again, one of my favorites is to use the butterfly when it's suited for particular directional trade. So here was Alibaba, and it was in a really nice steady uptrend, and it was trading at 115.20. So right here, our directional trading model was very positive for momentum. These are momentum flow indicators that we use. So it was very trendy, fantastic looking trend to the upside. Momentum flow was good. So we were looking for a push to 120. This was also based on unusual option activity. So I like to look at Fibonacci levels, and then I also like to look to see if there's any unusual option activity, and that gives me good solid price targets to trade against. So in this example, it was trading at 115. We saw good unusual option activity, so we wanted to set up a target trade for 120. So it's the perfect setup for a directional butterfly. So this was then setting this trade up was to do a directional butterfly, and it was buying the 116 call, okay, selling the 120, so $4 wide spread. So if you look at that, what is that? It's a long call debit spread, and then it was selling the 120, buying the 124 call. So what is that? A bear call credit spread. So you put the two together, and you've got your butterfly. Now, the maximum risk of this trade, it's a $4 wide spread, is 82 cents or $82. So your risk, the most you could lose would be $82, okay, per spread. The max theoretical profit then is your width of the spread, 400, minus your cost, 82, would be 318 per spread. Now, that would be a 388% return, or 3.8 to 1 positive risk to reward ratio. Now that's the beauty of it. And the other thing is this is kind of like, you know, once you get into this trade, you don't have to constantly monitor it. You're looking for this trade directionally to push to the upside. And there are ways to defend this trade even if it goes against you. But the main thing is if you have a target, which we have 120, this is the perfect strategy for that, because it'll just kind of grind and gives you that max potential profit as you're getting into that expiration date. So in this example, you know, over a 15-day period, it went up and made $290 per spread. That's a 350% return on your capital at risk of 82. So let's take a look at the profit tent to show you what that looked like. So here's your profit, your risk profile on your option analytics here. So what you're seeing is the profit tent here is this teal color. So that shows you what your underlying profit profile is for this option strategy. Now the purple line here is what it's actually doing in time. So here you can see that purple is right up there at the top of that profit tent or profit zone at the very top, and this is going out at expiration. So expiration was here on the 12th. So this was just leaving it on, and it was just grinding higher all the way and hit that 120 right here into that Friday expiration. And that was the max potential profit zone or profit point you could get. So it went from an 82-cent debit or $82 to a $372 debit. So that's you know, $290 per one option spread, or over 350% return on your capital at risk of 82. So fantastic risk reward there on a very small capital at risk. So that's the thing I love about it. Low stress, low at risk, but with potential high payoff. So that's a directional butterfly trade on Alibaba. Now here's another example. This is on GLD, which is a gold ETF. So it works great for stocks or really anything. I mean, you can use it on crude oil, you can use it on ETFs, fantastic on ETF stocks. The first time I really got involved with the butterflies was back when, you know, I'd set up a crude oil options brokerage desk, and we were doing like a 25,000 contract butterfly spread for this big hedge fund. It was just really unique and amazing what they were doing. You know, they were looking just to target a certain price point and then wait it out. So, you know, that's basically one of the trade examples, but you know, you can take it and incorporate it then within anything you're doing. So these are some examples to kind of illustrate that. So here is on the ETF GLD. Now again, a directional trade setup to start with, but you know, gold had a big move down and then started to turn. And again, our indicators were pointing for an upside move. We had a trend line break. So gold at that time, GLD, the ETF, was trading at 115. And again, we had really good unusual option activity. I mean, gold was trading here at 112, and we had really good unusual option activity at 115. So based on Fibonacci at this 50% retracement from that high to low and unusual option activity, that put us a good price target to trade to would be 115. So another perfect trade setup or example or condition for the butterfly. So here again is just a simple butterfly trade. So on this one, did just a dollar-wide butterfly spread. So look how low your risk is on this one. So bought the 114, sold the 115, sold the 115, bought the 116. So there's your long call butterfly. And we were looking for a target of 115, the body. So it's 1 by 2 by 1. So this was structured for just a 9-cent debit, very small capital at risk. 9 cents would be $9 per spread. Now, $100 width, so minus your $9 at risk. So your theoretical potential profit would be $91. That would be over 1,000% return, or 11 to 1. Now, this trade was held for 15 days, and it actually made $72 per spread on $9 at risk, so 800% return. So that's a nice way to smooth out your equity and on a very low stress type basis. So here's what it looks like going into the profit tent. Almost nailed it right there, 115.18. So right there at expiration on the 20th. And on that date, it went from a 9-cent debit to an 81-cent debit. So that's $72 per spread on your risk of $9, 800% return. So that's another one that's just a beauty of low capital at risk and high reward for that kind of targeted trade. Now, here's one of my favorite. This is the unbalanced ratio butterfly. And this is an example on Citigroup or Citicorp, the bank. Now, the unbalanced butterfly or ratio butterfly, also referred to as the ninja butterfly, it's a variation of a regular equal strike butterfly. But what it does, it adds an additional short, this is the key, it adds an additional short vertical credit spread to the structure. So basically, it's simply two in-the-money credit spreads protected by a slightly narrower, closer to the money debit spread. Okay, so it creates a very unique structure. By doing this type of structure, it gives you a very low defined risk directional option strategy to use. Now the strategy, what it does then, by having two credit spreads to one debit spread, it alters and shifts the risk into one direction, gives you a directional bias. And so what that does, that then increases your potential reward in the direction of your directional bias that you structured it for. So for that directional bias, then you can use puts or calls. So here's an example on Citibank. So this was a long call ratio put butterfly. And at the time the entry was set up, it was trading at $62.30. The target was 64. Okay, why the target 64? Again, this was based on Fibonacci levels. So we had what we call here a volatility squeeze. We were looking for a target up here to this 1618 retracement right about 64.40. And so we set up a put ratio butterfly, very low risk, to take advantage of this potential pop to this area. Okay, so it did, our trading model was, giving us directional to the upside out of the squeeze. And so it did pop up there to that 64 level. And so we were able to take profits up there going into expiration. So here's the trade setup on this ratio butterfly. Now, here's just kind of the construction of it to go into a little bit more detail. So Citi was trading at 62.30. We had a target. We were looking for it to go to 64 based on that Fibonacci level. So this was buying one in the money 65 put, selling one in the money 64 put. So what is that? A long put debit spread. Now, we shifted the direction to this to the upside by selling two 64 puts and then buying below that two 63 puts. So when you break this down, what do you see? So you've got a 65-64 debit spread one time. Then you've got a bull put credit spread two times, okay? So this is your bullish strategy. Here's your bearish, but it's 2 to 1. 2 to 1, okay? So that's the ratio that creates this upward bias. But the very beauty of it is the structure itself by taking advantage of time decay and implied volatility collapse. So here was the trade setup. It was on the 8th, and we were targeting 64. It was trading around 62. It was trading right here at 62.30, and we were targeting 64. So we did the 65, 64, 63 bull put ratio butterfly. And this is a dollar-wise spread, so you can see how low the risk is here. So your spread width here, 65, 64, gives you $1. So the $100 would be your spread width. Now your credit you received on this trade when we set it up, 50 cents, $50. So the credit received is 50. So that puts your at risk the difference. So the most you could lose on this trade would be $50. Now your profit starts out at $50, the credit you receive, but goes all the way to 150. So you've got a huge profit zone. So potential for a profit from $50 all the way to 150 on a risk of 50 if you do nothing to defend it. So that's the beauty. Okay, so here's how that turned out. Let's take a look at the profit 10. So on the 14th, took partial profit once it started hitting our target of 64. Okay, so you can see here, this is how that analytics work out. Here's your underlying put ratio butterfly, what it looks like, that teal, and the purple is what it was doing in time. So here's where it was right here, trading at 64.15 on the 14th right here. So the profit there, it went from a $50 credit, now it flipped to a 10-cent debit. So that's a $60 per spread profit on your risk of 50. So that's 120% return on that partial profit take there. Okay, so that's that was partial profit. Now, what you want to try to do is try to see if you can hold into expiration, because that's where you get your most maximum profit potential because of volatility collapse going to zero, implied volatility going to zero, and time decay going to zero. So here's the difference. 2 days later, it made 2 times more money by being able to hold in for 2 more days into expiration. So on the 16th, 2 days later, it was still trading at 64.08. See here, see the beauty. So 64.08, so time decay was going to zero, implied volatility was going to zero. So you can see that the impact of that structure then created a profit of 118 per spread, which is a 236% return. So you can see here it was a 50-cent credit. Now it flipped, and now it was a 68-cent debit. Okay, so that's 118. So, you know, here's the ratio was 1/3/2. So here's 4 contracts. So that's the ratio. So it made over $400 on 4 contracts on a risk of $50 per spread. So you can see the dynamics of this. 2 days later, it made 2 times more money because of the implied volatility collapse and time decay. Now here's one more example to illustrate that again, and this is on CRM to show you how this made 3 times more money 1 day later. And again, this started out as a directional ratio butterfly, looking for an upside move. And again, the targets were picked based on Fibonacci analysis. So here's, we were looking at that point in time, CRM was trading at $78, so right here, and we were looking for a move back up to that prior high of 80. Okay, so our momentum indicators, our model set up, so we set up this trade just looking for a target to 80. Now you can see that these can be very short duration trades. This was set up on the 30th, taken off that week on a Friday. So took it off on a Thursday, Friday, but we were also only looking for a $2 move up. But these can offer some great profit on very small moves and also very short duration. So here's the trade setup. So again, this was doing a put ratio butterfly to directional bias to the upside. Again, a dollar wide spread. So 81.80, 80.79, dollar wide. So credit received on this was $52. Okay, 52. So the max risk is the difference of 48. Now the potential theoretical profit then would be 152, which would be 316% return. So you can see here, maximum potential risk 48, maximum profit. So here you've got a potential profit from 52 up to 152, and your maximum risk is 48. So let's take a look to see how this performed going out. So on the 2nd, which was Thursday, it was trading right here, almost right at $80, $79.93. So this went from a, when it was put on that Monday, a 52-cent credit to an 8-cent credit. Okay, so covered partial profit there on that Thursday. So that's $44 per spread. Your risk 48, so it's 91% return, over 4 days. Now, 1 day later, and this is due to implied volatility collapse and also time decay going to zero, this now went to $136 profit, which is 3 times more on that risk of 48, so 283% return. So you can see here, just 1 day later, it went from a $52 credit, flipped to an $84 debit, so giving you a really good pop on your capital at risk for 280% return there. So again, it just has such a dynamic structure to use. And if you'd like to learn more about how to master this high reward, low risk strategy, you can do it right now. So I've got, for today's group here, I've got 20 slots if you're interested. This is a fantastic butterfly course that I put together. It's on demand now. It's a 5+ hour course. And if you use this link here, you can get the course for $97 today, and plus all the bonuses here. So it's an on-demand 5-hour course. 100% on this option butterfly strategy. So it's broken down 30-minute modules. You get the full PowerPoint, and let me show you the other bonuses you get. So first off, you get the 5-hour on-demand course, 30-minute modules. So you can go to if you decide to buy it later and don't want to buy it today, it's on my site, powercycletrading.com, at $297. Now we'll also do a live follow-up Q&A. Do this in about 2 weeks. You'll get an email about that. So you can come in and ask whatever questions you have on it. You're also going to get my bonus strategy manifesto on options, 15 option strategies. I'll show you this in a minute. My Greek power tool guide. And for anybody that's never been a member to my trading club, you'll get a free membership 1-month trial. If you continue, it's $97. But you're going to get all this today, plus the course, just for $97, on demand, 281-page training manual. My courses are very, very detailed. And here's what's covered in the course. So we're going to start off in the course. You're going to learn the core basics that many traders just miss out on. They don't understand the butterfly and the core basics that you need to know. Which Greeks are important, vital, and how to use them for the butterfly. How, why, and when to use the long call or put butterfly. How, why, or when to use the broken wing butterfly. When to use and how to use the ninja ratio butterfly, how to use a broken wing ratio butterfly, the directional butterfly, the iron butterfly, the vacation butterfly. So this whole course, 5 hours, we go through every one of these spreads, when to use them, how to use them, and also then how to defend them if you want to make adjustments. So also, what are the best times to capitalize on these different butterfly strategies? Should you put it on 5 days out, 10 days, 15? How do you structure setups where you get that 10-to-1 higher risk reward, where you can put down, like you saw in that GLD trade, $9 and make 72? So, make over 800% return on that. Then how to profit from option volatility collapse and the theta decay. This is the most important part of the butterfly, is to be able to incorporate and profit from that volatility collapse and theta decay. So you'll understand that important components of time and price and how that affects and puts it to your advantage on the butterfly. How to make big profits on low risk option expiring strategies. So what we call when option pinning is when an option goes into expiration, it's going to pin at a certain strike price. So a lot of money to be made when you go into expiration. So cover a lot of this in the course, how to take advantage of option expiration. So then how to target the correct expiration strike price for pinning and profit from it. Now, the other part that we also cover is, basic Fibonacci analysis to set up price targets for these types of trades, because they are target type driven trades. When you do directional butterflies, you want to target to trade to, and so that's where Fibonacci comes into a big way. And then a step-by-step checklist for the butterfly, execution and management. And here's the biggest thing: if you get nothing else out of it, you're going to learn how to hedge a core position. So whatever position you have on, you'll learn in this course how to hedge it using the butterfly hedge, and also how to defend the vertical debit spread or credit spread using the butterfly. So it's a fantastic course. You're going to learn a heck of a lot, and it's only $97 for the first 20 that sign up here today. So hopefully you'll jump into it, and I look forward to working with everybody here in the future. Here's a little feedback. This was from Mitch. Larry, I learned so much today, more than any other course I've taken. Theta has just killed me all the time. And so he was very appreciative of this course because it helped him with his theta problems. Thanks, Larry. This was by far the best 4+ hour presentation I've listened to this year. I'm also left with imagining the opportunities available for having fun, making dollars at the same time with the knowledge you've imparted on us today. Sincerely, 10. So here again is everything you get. You get step-by-step blueprint trading course on the option butterfly. It's a 5+ hour recorded course, 30-minute modules, 281-page training manual, lots of detail on my I trade by example. So I show you, I teach by example, show you a lot of different trading examples of these particular strategies, how to use them. And then you'll get the bonus follow-up Q&A. And then you'll get my 15 option strategy guide. These are 15 of my favorite option strategies. So you'll get the risk reward profile, what they are, how to use the covered call, covered puts, protected puts, different strategies in the, the outline of those strategies. And this is something you can print out, put on your desktop. And then my simple and brief options Greek guide, so another guide you can print out, put on your desktop. And then one free month to my trading club, to give you access to my virtual trading room each and every day from 9:25 a.m. I'm in the first hour, and then the last 45 minutes. So we go through these types of trade setups, and also any intraday trades we're looking at, do a daily market updated videos. We do a lot of seasonality type of trading, so those are also incorporated in the trading room, the videos. Live weekly Q&A, Traders Educational Vault. You get a credit for every month you're a paying member, and then 50% discounts on everything that we have. So hopefully you'll sign up for this, and I look forward to everybody working with you in the future. And thanks again for having me here today.